I think it is a weak comp because their Q2 guidance was diminished a lot, and that's what really took the stock down. So I think the real issue here is they did 66 cents in earnings in the fourth quarter of last year, and they booked a similar level of mobility growth. So everybody was thinking, okay, now we can count on 25-30% annualized growth in mobility, and that's just not going to be the case here. So the other thing is, delivery was 4% year-on-year growth, and their freight was -8%. So, you have to ask yourself if there's just a sweet spot right now with travel that's going to, peak here, and that's really what they're catching is they're riding the revenge travel wave, and it's about over. Maybe they get through the summer, but it's basically just taking off the euphoria in the stock more than anything. They'll get some growth out of it. 15% year-on-year revenue growth, nothing to sneeze at. That's excellent. So, in all things considered, I think what they did is they saw that it was going to be weaker than the market expected. They were going to have a miss. So then they went ahead and decided to throw these equity write-downs that are from businesses in China and Russia and other places that their minority partners are not doing as well, and just say, hey, let's throw everything that's not going to work out right now, get it all done, and then clean up the balance sheet and the story for the rest of the year.
All right, so you just mentioned the delivery business, 4% year-over-year growth, but you're kind of scoffing at that. So what's your take on the delivery business? Obviously, the U.S. consumer under quite a bit of pressure when you look at middle income and lower income.
Yeah, I just don't understand how they can get a 20% markup on delivery and try to make money at it. I mean, when you look at the leverage of their growth, their bookings returns year on year are similar to mobility, but they just get so little cash out of that business. Whatever they have to pay, they have to basically deliver meals, not people, and there seems to be a lot more cost and a lot less profit for them in doing that. And so they just don't get the leverage. So, they're really kind of a one-horse show here. They put investments into freight. They bought a company in 2021. They've got a deal they announced with Instacart for the delivery business, which is grocery to add to the restaurant mix that they have. But at the end of the day, the actual revenue mix 55% now. Mobility used to be 50%. They're still, basically a one-horse show, and that's the Uber, passenger service.
Yeah, seeing your notes, you also think the 8% decline in freight is a bit disappointing and maybe even troubling. But in all fairness, the digital freight brokerage business has been under pressure, whether you're Uber or anybody else. I want to go to one other thing, the buyback. Uber ended the quarter with $5 billion in cash. The fact that they're doing a buyback, how do you view that? I mean, sometimes when you see buybacks, it's a sign that the company just isn't innovating. But this is a space where a lot of innovation could be on the way, either through AI or autonomous driving, or a combination, of course.
Yeah, it's fascinating. They did the buyback in February. Then they said, hey, we're undervaluing the business. And then they went on to talk about it, compensating internal compensation. So you have two worries here. One is, the CEO that came in and cleaned up the business 7 years ago probably brought in a team, brought in a lot of equity option compensation. So you worry that they're just trying to, cover up some internal decision making on that diluted the stock. Having said that, the other thing to worry about is the AI business. They actually were in AI in 2017 and exited in 2020. And if you look at the freight business, they just talk nothing more than AI. So they have probably been a first mover in AI and haven't monetized it. So in that sense, also you kind of go, well, I don't know. So the real issue here is, why would you put a buyback on the table? Your IPO price is 45, the stock hits 80, you go out with a buyback. That's pretty much the total opposite time that you would want to do it. The argument here they're making obviously is the one you made, which is, we have immense leverage, we have the AI boom on our way, and with travel bookings underway, we can actually take this way up to 160. But that's a real bullish bet in a market where a lot of the cyclicalities work against you now. Rates are still high in the United States. We've got a lot of stories like Starbucks and McDonald's where retail spending is falling. And you got to say to yourself, I think there's some things that don't smell right about this stock buyback. Let's put it that way.